And welcome back once again to all of our options traders out there. And it's time again for more idiotic ideas. This one is number 6. You can be wrong, but still win. Now, for those of you who might have missed the past 5, I got this from a book that I regretted buying, but I thought as long as I bought it, might as well make the best of it and use it as an example of what not to do. And again, I'm not going to name the author or the title. That's not my point. It's instead to show why you have to be so careful about where you get your information and why it's so important to understand options on your own so that you can see through really dumb ideas like this. So let's go take a look at idiotic ideas number 6. You can be wrong, but still win. As always, before we do, please be sure to click like and subscribe. It's truly appreciated and helps so much to promote the channel. So this is a quote right out of his book, and he says, the beauty of options is that if you design the right strategies, you can be wrong about the markets often and still profit. So he's saying that there's this group of, out of all of the strategies, there's some that are the right strategies, and most of the time, you could be dead wrong about the markets and still make money. Well, what does that sound like? If he's trying to sell you something, it sounds like, boy, I could be wrong a lot of times, 75, 80% of the time, and still make lots of money. And so if I can just limit my losses, I'm golden. I'm going to make all the money in the world. So what could he possibly be talking about here? Well, let's first start off with long options, options that you buy. Long options have extrinsic value. And because of that, if you buy an option, you need the stock to move to show a profit. You need to make up the option's extrinsic value, or the time value. And another way to understand this is that long options have positive gamma. That's another fancy way of saying that we need the stock to move. And that is also coupled with negative theta. Anytime you have positive gamma, you will absolutely have negative theta, assuming we're talking about the same expirations. And so if we have negative theta, that option's price is decaying over time, so we need the stock to move in order to make a profit. So it is absolutely true that buyers cannot be wrong about the direction and profit. So we can see this from a risk graph. We've seen these before. Here's a long call, $100 call purchased for 3. And we get our bend right there at 100, maximum loss right there at 3. So the black curve is the expiration graph. That shows our potential profits or losses at expiration. But the blue curve shows the profits or losses today. This is called the current curve, and the difference between the blue and the black is the extrinsic value. So as time goes by, let's say a week later, we might move from the blue to the green, and then down here to this light blue, and then down here to the red. You can see that the value of the option is decaying. But if we paid $3 for this option, the break even is the $100 strike plus the $3 premium, or 103. So you can see that with the strike right here at 100, we've got this range right here where we are going to lose even if the stock does rise. Now, of course, this is by expiration. If we go anywhere between 100 and 103, we are going to have a loss, not 100% loss, but some type of a loss, even though we were right about the direction. Now, the way that we get 100% loss is anywhere below the strike. And in this example would be $3. So again, this is a very easy way to show when you look at your risk graphs that long options absolutely need the stock to move. Okay, so what about the other side of the trade? What about short options? Well, short options benefit from the passage of time. Everything's going to be opposite about a short option. They will have positive theta. They will benefit from the passage of time, assuming the stock price stays still, but they will have negative gamma, meaning that you are going to be fighting the market. You're going to be selling into an uptrend, and you will be buying when prices are falling. So sellers need the stock to stay still to show a profit. And because of this, they don't have to stay exactly still, but they have to stay in a fairly small range. So that's the key to see, is that sellers can be wrong about the direction and profit, but only over a limited range. So he fails to mention that in his quote. He's saying you can be wrong and still make money. Well, sort of true. It's only over a limited range. So let's look at the other side of that long call that we just saw. Here is the person who sold the call. Again, we get our bend right there at 100, but now we've got unlimited risk to the upside. So we can see that our profits, remember here is 0, that horizontal line. So if the stock stays right here at 100, watch the value of the curve. Now we move to the green, then to this light blue, then to this red. Do you see how that curve is getting higher? It's moving above 0. We are becoming profitable if the stock stays in a fairly narrow range. That's the part that he doesn't tell. So again, here's our current stock price of 100. Anywhere to the downside, we will profit. We have negative gamma, positive theta. If the stock sits still, we're good. And if the stock falls, we're good. But we have this break even right here of 103. So if the stock rises to 103, remember that's the premium that we received from selling this. The buyer paid 3, we received 3 as the seller. So we can afford to have the stock rise from 100 to 103 and still make money. We're not going to make the maximum amount, let's say if the stock is 101 or 102, but we will still make something. We can see that that black line there at expiration is above 0 for all stock prices at 103 or below. Now, if it goes above here, that's when we start heading into losses. But if it stays below, we're going to make the maximum gain, or we will at least make some gain if it rises up to 103. So yes, it is true that short options do not need the stock to move. And in fact, they can afford to have the stock move against you a little bit. That's the key. It's a very narrow range. Now we can also see this if we compare, let's say, a long call here in black to a short put in red. And sometimes you'll hear traders say, oh, well, the long call is better because you make money if the stock rises and you lose less if it falls. Well, that's true, but take a look if the stock stays still. Right here. Now the short put is going to make money. See, the short put can make money anywhere in this range. Right there between these break-evens. They will make the maximum gain for any stock price above here. But if the stock goes above this crossover point, where the red and black lines cross, the short put will miss out on gains. That's not a loss, but they're going to miss out on gains. But over here, they will absolutely take losses. And you can see that they are unlimited losses. So he doesn't mention that either. By designing the right strategies to where you can win even if the markets move against you, you are facing different risks. And if you're not aware of what those risks are, it's really easy to step into traps. So always be careful when you hear about right strategies. He's claiming that the right strategies are always selling. And for short options, remember, the premium that you receive equals the expected loss. So there are no free lunches from selling. So the main thing to take from this is that options trading is about finding favorable edges. And sometimes that's on the sell side, other times it's the buy side. But to claim that a secret to options trading is to always be on the sell side is simply an idiotic idea. It's reckless. If sellers always had the advantage that so many traders believe, nobody would ever be the buyer. Set goals and devise strategies around that goal and not some imaginary benefit. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.